Fundamentally, I think gold looks pretty strong. From a fundamental point of view, I'm on the bullish side, and you never exactly know what these central banks are going to do, but the trend is your friend, and the trend right now is a lot of central bank buying, and the reason behind that, I think, is that they're just simply a lot of uncertainty. Everything has become more and more politicized in the realm of fiat money, shall we say, and as a result of that, the central banks are accumulating gold.
Gold breached $2,000 per ounce multiple times this week, and prices hovered around that level Friday afternoon as U.S. traders roused themselves from their tryptophan-induced Thanksgiving torpor and returned to metals markets. Nonetheless, emerging market currencies, such as the Australian dollar, Canadian dollar, Swedish krona, and South Korean won, have substantially benefited from the shift away from the U.S. dollar. SteveHanke, founder of the Institute for Applied Economics, offers bullish sentiments on gold due to rising central bank purchases and concerns about politicized fiat money, especially the U.S. dollar. Central banks worldwide have been accumulating gold reserves at an accelerated pace, with demand for gold surging by 152% year-over-year in 2022, marking the highest level since 1950. As per Steve, a recent gold buying trend has been seen across countries, including unexpected ones like Poland. The National Bank of Poland, NBP, continued its buying spree in the third quarter, adding a further 57 tons to the 48 tons it bought in the second quarter. This brings its YTD gold accumulation to 105 tons, in line with its previously stated aim of adding 100 tons to its gold reserves. Steve notes geopolitical shifts from U.S. sanctions, pushing central banks to diversify from the dollar, while he also suggests going long on gold. There has been much discussion recently on the prospect of the U.S. dollar losing its global dominance. For almost 8 decades, the U.S. dollar has dominated central banks' global trade, finance, and reserve portfolios worldwide. The decline in the dollar's share in global reserve currencies has generated debate on the effect of the U.S. financial sanctions. Now, we present the clips of SteveHanke's insights from his recent interview with Commodity Culture. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
You never exactly know what these central banks are going to do, but the trend is your friend, and the trend right now is a lot of central bank buying, and the reason behind that, I think, is that they're just simply a lot of uncertainty. Everything has become more and more politicized in the realm of fiat money, shall we say. As a result of that, the central banks are accumulating gold. They're not big players in the market for some time. Now they are. Particularly the ones that are in this kind of de-dollarization mode. They want to lighten up on their dollar exposure because the U.S. has so politicized and weaponized the U.S. dollar, particularly sanctions. I mean, since 9/11 and the war on terrorism has started, sanctions have just gone up, and now with Biden, they're really on steroids. They were going up very fast with Trump, by the way. So it's kind of a bipartisan thing. It doesn't have anything to do with political parties. It's just, I think it's utter stupidity on the part of the United States, but that's a reality. So you've got China buying big, even Poland. Poland is a big buyer in the last quarter, and Polish officials essentially said just what I was saying. So that's the fundamentals. Now, on the short-term aspect of gold, for me, of course, I'm long. That's as an investment. But now let's look at trading. Even if gold stays the same throughout the year, the same price at the end of the year as the start of the year, it fluctuates around. And to pick up that fluctuation and trade on it, it's still really in the industrial category. It trades differently than gold. I mean, gold has an industrial component, as you know, but it also has a big financial store of value component, this huge central bank buying. I mean, how many central banks are buying silver? I mean, I don't know if any of them are, quite frankly, but I don't have anything really very constructive to say. I mean, You just enunciated what one analyst has put forward, and that is bullish. But remember, the market price of something is an objective value. All these individual analyst reports, that's a subjective analysis of what some analyst thinks. And then you and I and thousands of other people take in all those subjective things, and we decide, oh, is the market price that's objective, is that above the subjective level or below? And if the market price is below where we think the subjective level is, we buy. And if it's above, we sell.
By design, U.S. industrial policy benefits both domestic and foreign companies investing and producing in the U.S. Meanwhile, SteveHanke expresses concern over the U.S. adopting industrial policies similar to those of Europe, predicting potential economic challenges in the long run. Berkeley, industrial policy has surged to the top of the national agenda in the United States and other advanced industrial economies. He also criticizes sanctions, pointing to cases like Russia and Venezuela, where they often backfire, bolstering leaders through a rally around the flag effect. The largest sanctions of all have been imposed on Russia in response to the invasion of Ukraine, yet they highlight a significant failure in achieving their intended results. Combined with the Ukrainian counteroffensive's shortcomings, there is a growing perception that the war might conclude in a stalemate or even a Russian victory. Let's get back to the interview.
Do you agree with that view? And if so, are those nations going to lose the growth and efficiency associated with free and open societies?
Oh, they're all slowing down. The U.S., I just last Friday, Sean Tully published an article, a long interview with me in Fortune magazine. We were talking precisely about this. Industrial policy, they call it, and industrial policy is where you have the government picking winners and protecting losers with subsidies and that kind of thing. So the U.S. has not really practiced open industrial policy. And now with the Biden administration, they've adopted explicitly, as of April, a speech that the National Security Advisor, Jake Sullivan, gave at the Brookings Institution. You can Google and find the thing easily. That lays out a new economic model for the United States, which is an industrial policy model. So that means what? The U.S. is going to copy what they're doing in Europe. You know, of all things, I mean, the French are even bitching about this industrial policy thing the Biden administration has adopted. They say it's kind of over the top. So the U.S., I anticipate, is going to be in for economic trouble in the long run. This outsized increase in productivity and GDP that I've said over the last 50 years in the United States, that gap is going to narrow, because the U.S. looks like it's moving in a position kind of copy Europe, have more of a European kind of model. And this, I think, is going to end up being a disaster. It follows, by the way, logically, because U.S. sanctions are what? Sanctions mean that the government and politicians are getting in between a willing buyer and a willing seller. That's sanctions. Now, what's protectionism? Protectionism is also the same thing, getting in the way politically of willing buyers and sellers. If you accept that and you're comfortable with it, which the U.S. population seems to be with sanctions, because both political parties are all behind this. Look at Russia. Russia now is going to grow at a little under 2.5% per year. Look at Germany. Germany's added all these sanctions against Russia, and they're going into a deep recession. Europe's going into a huge recession because of all the sanctions, among other things, all the sanctions that they put on Russia. Even more popular than he was before war with Ukraine, because once you put sanctions on somebody, you have a rally around the flag effect. That's why Castro stayed in power for so long. That's why Maduro in Venezuela, he's been in power 10 years, and they've had two hyperinflations in Venezuela in that 10-year period, where inflation rates have gone over 50% per month. And Maduro is still in power because of U.S. sanctions and the rally around the flag effect. What about North Korea? Got all kinds of sanctions. What about Iran? The regime's still in power in Iran. The sanctions keep them in power. The Western politicians are literally stupid. They're very poorly advised. I have a big library, books on sanctions. They almost never work. They're a fool's game, basically.
Emerging market currencies and unexpected gold accumulation by countries exemplify the continued diversification away from the US dollar. The latest Kitco News Weekly Gold Survey sees retail investors as optimistic as ever going into next week. At the same time, a majority of market analysts have joined them on the bullish side, albeit with a significant minority neutral on the yellow metal's near-term prospects. How do investors adapt to these evolving dynamics, which play a pivotal role in shaping the trajectory of gold in the coming years? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.